All right, good evening, everyone. Welcome to the Hurley Investments Market View Commentary for the 1st of February 2021. Now, today, I'm going to go through a couple different things, but the main questions that were brought up that I think were pretty good and that I wanted to focus on were: explain your earnings season, and they said pattern, but I'm going to say pattern, or I'm going to say trading techniques. And if I'm wrong on how that's said, let me know. But plain and simple, what we look for at earnings are to protect positions. So we have Ford protected at 1150, and it's currently trading closer to 11. So what we will normally do is, before earnings, something we paid 79 cents for, that we can maybe get 119, 40 cents out of the 50 cents downward movement, we're going to capture that. And what we will most likely do is we will start to protect at $11, and we'll maybe roll it out and down to be more at where this position is at. So I think what you're trying to get at, David, and you saw us do it today on some things in a way, with Ford, what we were trying to do is to roll the 54 to a February 11th. And we were trying to get, pretty sure it was 38 or 39 cents for it today. Kevin, why don't you go out and get an extra week? We can. But is it worth that 11 cents or not? We don't know. So all we were trying to do today, as you saw in your accounts, we wanted to capture 40 of that 50 cents down. So we were trying to roll it down. If you look at Disney, we worked on Disney exactly the same thing. For some of our accounts, we rolled from a 175, and we found out we could go down to a 172 and give us one more week of time. So what we were doing was we were taking this 867 that we purchased, rolling it for about 30 cents of profit, and we were rolling it to a 172.50 one more week out in time. So the question is, how are you looking at doing this? And I'm going to go ahead and I'm going to put a couple things that we're looking at. First, if the stock has fallen, we take profits and want the protection at the money, which is equal to close to the current price. Why are you doing that? Because if we don't take the profits, we can't make anything to the upside. And that's the main key. We cannot make anything to the upside. And for whatever reason, my screen was paused there. So what I was trying to show you, Disney, we had a bunch of shares of stock at 175, and we had about 40 cents of profit. So what we decided to do is take the majority of these. We still have 14 left to do tomorrow, and we're going to roll them. We're going to roll them out for a week and down to 172 and do it for zero cost. That was our thought process. We're going to buy an extra week for zero cost. On Ford, We tried, it didn't work. We're going to try again tomorrow. We're going to try to roll down to $11, and we wanted 39 cents or 40 cents. We wanted to capture 80% of the downward movement on Ford. And some of you were going, well, what is he doing? It comes down to the premise. If we have these positions that are in the money by 2, 3, or 4 strike prices, then we're not going to be able to make anything if it pops up to the upside. We just can't do it. So what we're trying to do is before earnings, we are trying to do everything we can to take a profit. Yep, you're going to notice it on Under Armour. We only had 4 of them that rolled down today. What we're trying to do is we're trying to take these 1950s and just roll them down to 19. And to do so, we want to capture 40 of that 50 cents to the downside. Now, Bill Brandner talked to me the other day, and it's kind of interesting because he said, oh, did you guys make a mistake? Because sometimes you will see us go to try to make, I'm really trying to make 12 cents is what I'm trying to do. And what I try to do is on the days that I know I'm going to adjust my puts or I need to add puts, what you might see me do, if I can see one bounce, I will try the best I can to add. What we try to do if we know we're going to add puts, we try to start off adding calls. And what I'm looking for is a double or a triple bottom to where I can add a long call and try to make 12 cents to the upside. And this one, it was 740 to 780. I probably would have made about 20 cents. So occasionally, you're going to see in your trading account, hey, Kevin, you added a call. And I do the calls and the puts. I see what the overall price is. What I'm trying to do is gain 12 cents. 12 to 14 cents seems to be the sweet spot. It doesn't make sense to gain 20 cents on the calls, but then lose 30 cents when you have to buy puts at a more expensive price. And I'm just looking for it. Normally it's in the morning, a double bottom, sometimes a triple bottom, where I can add a call, run it up for a profit of 12, or in this case it would have been 20 cents, and then buy a put. In the case, this one would have been probably down here at 750. We might have taken one up here at 18. But occasionally, if you see calls and puts the same day, all I'm trying to do is to make a little profit. The other day, we made 4 cents on, and it was just between breaking even on the call, but the put price came down by a nickel. So you're going to see us occasionally before earnings try to scalp 12 cents. 12 cents on 1,000 shares is 120 bucks. 12 cents on a couple thousand shares could be as much as 480 to 500. That's the most I've ever done when you see calls and puts in the same day. So no, I'm not making a mistake. What I am trying to do is to position your protection to give you the best bang for the buck. Now, obviously, if it's way in the money by like $20 and has this big profit, if your stock continues to go down, then we'll make a killing on that put. But more often than not, if it's already made a bunch of money, you typically see a bounce higher after earnings, And if you have all this profit in the puts, you basically are giving away any upside opportunity. So in simple English, we're trying to put your insurance as close to the value of the stock just before earnings. If we put on a couple of weeks before and it has a profit in it, we're taking that profit and we're going to then put the protection on at the money, and then we'll let it run after that. Hey, Kevin, on up days or down days, should we expect our accounts to do as good or poorly as the broader market? And hopefully you're talking about the S&P. There's no one that's going to compare you against the Dow or the NASDAQ. And the question was more along the lines, like today, if the market is up 1 1/2%, should our accounts be as well? And so this is another great question, but the answer is no during the earnings season. And what do I mean by this? The short answer is yes. In between those earnings seasons for that 6 weeks, yes, you can't expect it. Rarely, if ever, do I look or care about a single day. If we're off the markets by 0.5% up or down, then I've got to pay attention. If we're beating the market by 2%, 3%, the market's flat, I might be over leveraged in something that's doing extremely good that day. That also means that if we're over leveraged and we're making 3% more than the market does on an up day, on a down day, we could very easily be making 3% less. So the short answer is you can expect whatever you want to expect. For myself, it is a process, meaning, yes, I look every single day for being overweight in a individual stock position. Weekly is a statistic for me, and monthly is what matters most. I look at every account every single day, and if I'm up or down by more than 0.5%, I have to justify it to myself. With that said, some of you should have noticed today, E-Trade went through an update, and there's a problem. Today's net gain showed 153. But they had a problem over here with the net gain and some options expiration over the weekend. 2 exact positions, and they're off by $61,000. Not good. Not good at all. Which means I've been spending the afternoon going over individual accounts. Complete view. Let me put you on pause for a second so I don't show someone else's portfolio. And so I go through and I try to find out, okay, is it correct? What's going on? Am I up? Am I down? What's making sense? What's not making sense? And I have to run my calculations to make sure tomorrow as it comes through that it is correct. And for that reason, I don't care too much about a single day. Each week I take statistics. Hey, where are we at? We up or we down? And then I also take those statistics against what we still have in play for earnings. I usually know that half of our core holdings are going to be in 1 month of the earnings season. And then the second half of our core holdings will be in the second month of earnings season. Kevin, why do you do this? I spread out earnings season stocks so the market risk won't affect the whole portfolio. What do I mean by that? Well, there's market risk where you usually have the banks that start the earnings season off. If the banks don't do well, they will move your whole portfolio down. If they move your whole portfolio down, they're going to move other stocks that don't necessarily mean it or need it. Meaning, if banks move technology down, I'm making sure I take profits off of my puts for technology, moving it as close to where the stocks have their earnings, and normally see technology go up if finances are down. Same thing, if you see bank stocks take off, then usually technical stocks will go down. They work in an inverse type of relationship. So through the earnings season, when companies have their earnings, I try to put your portfolio where you're going to start off with some banks. The middle of your portfolio usually ends up being some technology, and the end part of your portfolio will usually end up being the retail. What does that mean for a portfolio? Bank of America, JP Morgan, Key Corp, Zions Bank, Goldman Sachs, US Bank Corp, Visa. Those will usually fit in the front part of your earnings. In the middle, you're going to have Micron, you'll have Intel, you'll have Apple, you'll have Baidu. I try to squeeze some of those technical companies in the middle. Those are usually followed with materials or the automobile industry, General Electric, GM, Ford, Caterpillar, Deere. And we usually will finish up with something that's a little bit later on, which will usually be Under Armour for retail, Disney. Sometimes you will see Baidu be pushed into that end out of the technology sector and in international, but I run portfolios for a reason. And if I let every single day worry me, I'd be toast. If I let every single week worry me, I'd be toast. Yet, it does, on a monthly basis, I do need to pay attention. And I pay attention for, someone asked, do you see a base for any of the positions and also enough profit to take long puts? So last Friday or last Thursday, we took profits on Bank of America, added shares, 100% paid for, and then added long puts back at $30. And so that was actually last Thursday, and Friday we added it back in. So the question is, do you see a base rate of the positions and also enough profits on the long puts to buy shares? Already doing it. Already doing it, already on it. Same thing if we look at some of our positions and where we're at. Because we have so many Under Armour positions, that's another one that what we spent 166 worth 227. Doing the math, if we have like 2,000 shares, we have enough to add another 100 shares. So we're always looking at seeing where we're at and where we can add shares. Today we did something a little different, a little unusual for us. We took some protection off of Apple. We have 10,900 shares of that protection. We have another 9,000 with protection. Kevin, what are you doing? Well, we took a look at Apple on our chart. And we took a look at Apple and said, you know what? Kind of interesting. Great earnings. Earnings were stellar. And it looks like it's just bouncing off of the midline on the RSI. It was just trying to get above the 134.48 center pivot point. We do not have our crossovers here. We're getting upward movement of capital being put into Apple again. Is that possibly going to go down like here? Could it be this movement? We don't know. But it's Apple. And we also read today that Apple just sold $14 billion worth of bonds. I didn't put it in here, but the short answer is Apple just spent $14 billion on a bond. They have 14 billion reasons to go buy more shares of stock. Let's do the math, because I think the math is kind of neat, right? We have $14 billion. There's million, there's billion, right? And we have Apple today trading at roughly, and this is how they're trying to decide what they're going to do, right? At 134.27 after hours. If we take 14 billion and divide it by 134.27, we get 104 million new shares that Apple's going to take off the market. They're only paying $1.60 in interest, 1.6%. They're backed better than the U.S. government right now, having $200 billion on cash on hand. What did Apple decide to do today? Pretty easy. Pretty simple. Apple said, let's sell 140 billion. It's not true. 14 billion in bonds to buy back 104-ish million shares. It will cost us, and they're only doing 2 to 3 year bond cycles, right? I'm going to go on the easy side. I'm going to go the 2 year bond cycle. It'll only cost us $3.20 per share over the next 2 years. So if our stock price raises more than $3.02 over the next 2 years, we've made a profit. Does anyone here think Apple will go higher than $3.20 in the next 2 years? Yes, no, maybe so. What do you think? Will Apple make more than $3.20 in the next 2 years? A bunch of people, I had one that said up. I've got 4 yeses. I've got an of course, and I go, duh. I think so as well. It's a no-brainer. They basically just took out of circulation 104 million shares and put it in their treasury. Kevin, what does that mean? Well, for a new hire, they say, hey, you stay with us for 3 years, we're going to give you 100 shares. 100 shares that they bought at $134 that may be worth $250 down the road. They bought these shares to inflate their strike price as an expense against their revenue. They created a liability of $14 billion. To an all intents and purposes, double their money. And it's unique because it doubles the money that they spent on it as they pick up more shares. Their treasury of shares has to be worth $1 trillion. They're inflating the price of their own shares. They're making shareholders happy. And they still have a cash hoard that ranks higher than higher than all the other countries in the world except for the top 9 or 11 or 7. I don't know how many it was. But it's ridiculous. The amount of money that they're making by borrowing money at a ridiculously cheap price. Let me see if I got all the questions from you guys answered. They also asked, explain your criteria in making these decisions. The criteria changes. But if I've got that 10%, I'm looking to add more shares. I just decide, hey, am I going to do it now or is we going to let it wait? Then we're going to get a bounce higher. It doesn't make a whole lot of sense to add the shares and then have the shares continue to go down. My watch list. As we get to the watch list, I take the companies off that have already had their earnings. I literally just delete them. And I shrink my watch list down to what currently is coming up in the near future. I told you guys, banks, technology, typically has already been done. We still have Baidu, CVS, Disney, Ford, Coke, Micron, Newmont Mines, Target, and Under Armour. We have retail still left. Micron is an outlier that falls outside of the typical earnings seasons. They're out of that 87% of all companies that report their earnings. Let's see here. These ones are out. Square, we got Royal Caribbean Cruise Lines and Carnival Cruise Lines is 0 Where do you think our markets are going to move at the end of the week? I'm going to go down again. We were down, what, 1.5% for January. I thought we'd be pretty flat. Let me tell you exactly where January finished. January finished down. January is down 1.25%. You saw me say, hey, I think we're going to be down January, be flat. You know, basically it's flat, 0.00, right? Well, if you're asking where I think we're going to go for February, I would probably say we're going to be down 2%. And a lot of people said, well, how are you making these predictions? And sometimes I'm flat on where people said, well, why didn't you follow these predictions? And because it's an educated guess. It's the market as a whole. It's, hey, last year we should have learned something. And most likely we're going to see something very similar to this year. So if that's the expectation, are we going to learn from last year or not? This is what happened last year. Went up a little bit, a couple percent, bottom fell out, right? Can someone tell me what caused this drop last year? And please don't say Trump. I'm looking for something more mathematical, more concrete than that. What happened last year? Coronavirus, thank you. When is the worst of the coronavirus expected to happen this year? Jim and Russ, I'm going to comment on your comments here in a second. There you go. We're told March through April again, right? It's when the worst of the coronavirus will hit, and hopefully we'll have enough vaccine that will eradicate the strains that could be worse, and we can kind of get back to everyday life. Now, 2 of you said shutdowns due to COVID. If we double or triple our COVID count, does anyone think that the government's going to shut down businesses again? That's the question, right? Will the government shut down businesses again? And my answer is probably going to be yes. So because of that, I want to be protected for that scenario. That also seems to coincide with the earnings season. So I get to do both things at once. I'm going to follow that the best I can. I'm going to follow that to make sure that we're protected, and I'm going to learn from what happened last year. Do I think it's asinine to shut us down again? I do. But I don't make the choices, and it seems like that would be a Democratic agenda. And the only reason why I'm saying that is because some of the states that were worst hit with shutdowns seem to be democratically run. So that would be my fear. That would be why I'd want to stay a little extra protected and learn from our past experience. Now, I'm saying all that as I'm typing in here our economic reports, and we are going to have the most important reports come on Friday. We have the average work week, hourly earnings. We have the non-farm payroll, which is going to be awful. We're going to have private payroll, which is going to be awful. But it's expected this time of year. It's nothing that's really not expected, so to speak. Kevin, how can you say that? Well, a lot of people get let go after Christmas. So the fact that we might have even a negative number where more people got fired than picked up jobs wouldn't surprise me. Earnings. We had Rambus today. Tomorrow we really start going with Alibaba, I can't read my writing. British Petroleum. That's never a good thing, right? ConocoPhillips, ExxonMobil. Interesting thought process. There's talk of ExxonMobil possibly merging with Chevron. That's how they're going to fight electric vehicles. Harley, Pfizer, Sirius, UPS, Google tomorrow, Amazon tomorrow, FireEye tomorrow. Wednesday, Boston Scientific, Granger, Humira, Spotify reports, eBay reports, Grubhub reports, PayPal, and Qualcomm. Thursday is the big day. We have Clorox, we have Cummins, International Paper, Merck, Ralph Lauren, Tapestry. That'll be an interesting one. Formerly known as what? Coach. Yum Brands, Activision. Let's make sure I get that one right. GoPro. We're following that because of my son. Skyworks. Kramer talked about them this morning. Snap. T-Mobile. Also used to be known as Sprint. Wynn Resorts, for us, Carnival Cruise Lines, and Ford. And then on Friday, pretty easy day, Cardinal Health. If you have United Healthcare, this is one you're going to watch here as well. And you're going to watch Eli Lilly. Nothing internationally. Interesting report on 10 Republican senators present by with a smaller COVID stimulus package. It's smaller, and it actually kind of cuts out a lot of the stuff that doesn't go to Americans. So it's what they call a more targeted assistance to Americans with the greatest need. I would definitely like to see something like this versus over $1 trillion going elsewhere. Please read the bullet points. The bullet points are what's going to be most important. Article on retailers cut debt. A warning for retailers here that, hey, be careful that, well, let's see if they pay dividends or not. That's the short answer. For us, this is going to be more important to, probably more important to Ford, Under Armour. It'll be interesting to see where they go with this. All right, what else do we have? GameStop, some more information on GameStop. If you're in it, get out. If you got in at 380, don't do it again. This was only really good for those that are got in at, $30 or more, and they probably should have gotten out at 300 and taken their 100% return. Pretty interesting. Silver starting to spike. Hold on to those Christmas gifts. Those Christmas gifts might be worth anywhere between $100 to $280 here in the near future. If Reddit group, the Wall Street brats or whatever they call them, end up pushing that significantly higher. Very interesting article on Tim Cook condemns Facebook business model. Says valuing engagement over privacy leads to polarization and violence. Basically, Tim Cook badmouthed their number one competitor and made him look very foolish by saying if a business is built on misleading users, on data exploitation, the choices are not choices at all, does not deserve our praise, it deserves reform. He goes on to say, too many are still asking the question, how much can we get away with? One should be asking, what are the consequences? It's very interesting to see how Zuckerberg picked a fight with the wrong person during his earnings call. The CBO, very interesting. The Congressional Budget Office magically sees rapid growth recovery and labor force returning to pre-pandemic levels by 2022. That means this year, everything comes back this year. I feel that's a little optimistic. In fact, I don't see the basis for going through this right now. But it's an interesting article to see. I don't want to badmouth our government, but I'm just going to say how off government can be at certain times. And it's just something to watch. But plain and simple, government has never really been my friend. So pay attention to expectations and then validate them yourself. Validate them and send two comments just put in here. I would say wishful thinking. Yeah, right. Not going to happen. I love both those comments. It doesn't seem possible. But, man, it sure would be nice. That's all I'm going to say. It sure would be nice. Questions. What questions do you guys have for me tonight? This was not necessarily my best performance. I am going to be traveling this week. So you'll get an email tonight, little recap from what's going on, and Keeve will be watching everything. That doesn't mean I'm not going to be watching. It's just some days I will be traveling, and so Keeve will be more in charge of a couple things. But any questions you guys have for me tonight? Kevin, I'm going to write this one down. Kevin, what if you are wrong with Apple? Meaning I've taken profits already off of some of the puts. So what are you going to do if you're wrong? I will add puts back on farther out in time. Simple. If tomorrow we're down and there's some news that says, hey, we're probably going to head back down, if I'm wrong, I'm going to add the puts back in. The same thing we did with Bank of America. Hit the 50-day, bounced up, took profits, added shares. The next day, it went from, what, 30, 34, down below 30. $30 was the line in the sand. Boom, puts came back on. We're going to react to what the market gives us. And if we're wrong, we'll get them back in place farther out in time. And we've already taken $4 of profit on the $144 strike puts. I've got $4 to play with, and I can add protection for farther out in time. It's nothing to stress about. It's nothing to worry about. We're always watching so we don't have to. We're doing things to make money. It's our job. Don't panic because you don't have protection on. Again, we've got $4 to play with the profits we took. We can always put them back on if we need to. Great question. Countries are getting more and more in debt as preparation for a nice inflation is not the best perspective for the next 2 years. Yeah, I mean, it's funny. The neat thing about news is that the news is slanted to what they want to tell you. And they can forget the big picture. I thought news used to be a series of macro events that are reported on. And with all due respect, it seems like the news is getting very micro. Focus on one thing. I'll be honest with you, for the first time in my life, I'm not sure if it's true. And I guess you take it with a grain of salt. And the grain of salt I would take is I also don't see the growth. All the economic reports don't show a rebound. In fact, we're still on the own advisory firm for Biden saying it's going to get really bad in March and April. So let's face it, it's not going to end well for the economy. With that said, we might get 3 or 4 rounds of stimulus. This might be the year where it gives other countries a great reason to change the reserve currency status that the U.S. holds to a basket of currencies. And again, that is the main trigger for real inflation. Inflation in that 16% range that will happen over a 60-day period. So that's where you gotta be careful. Interesting comment, and then I'll get to yours, Jim. But interesting comment. What about a fiscal stimulus package for infrastructure? I would love to see that. I would love to see a fiscal infrastructure package because that'll put people to work. I'm not sure we're going to get that. To be honest with you, I'm not sure the sides will come together to find a way to spend that money. At least not this year. That'll be a next year where people are more worried about re-election. So I'm not sure I see an infrastructure bill coming through that will prop up the economy. I hope I'm wrong. I just don't see it. All right, what else came around? Government will make up economy and more of those shovel-ready jobs, right? I guess that kind of goes back into infrastructure. I don't think our economy moves off of minimum wage employment. And I'm not sure I'm seeing the Green New Deal replacing the oil jobs, replacing the transportation jobs from the Keystone Pipeline. In fact, there's a lot of credence to the fact that Bill Gates gave $50 million to the Democrats, and all of a sudden his Union Pacific rail lines are shipping oil again that they would not have been shipping with the Keystone Pipeline. So I don't know. You can just take care of numbers. Something that does surprise me, unions are right now no longer Biden's friend. Some unions are starting to come up with some issues and problems. And it's, I don't know if it's one of those that the hand that just fed you bit you. 11,000 jobs lost out of the Keystone Pipeline that did nothing but facilitate our energy dependence. Also, with one executive orders, mathematically, we no longer are going to be producing the amount of barrels of oil that the United States consumes. The United States has lost our energy independence as it relates to oil. It'll be interesting to see if we can make it up by pumping more in more established oil fields versus some of the new places that we've gone. Guys, take care. Appreciate you being here. Bye-bye.